Okay. All right. So we are about to start looking at a merchandising company that's organized as a corporation. When we skipped up to payroll, we did work with this company, but payroll didn't really have anything to do with the merchandising, and so we didn't talk about this at that point. But now we're jumping back. So chapters 1 through 8 was our service business. Now starting with chapter 9, we're looking at a merchandising business. And really it adds in some different transactions because we're buying merchandise, we're selling merchandise, and it adds in a lot of different accounts as well. Okay, so just to kind of take a look at the chart of accounts for the company, 3 green products that we're using for our sample problems in this part. You can see the basic accounts: cash, petty cash, things that we've seen, supplies, prepaid insurance. One thing I do want you to notice is that we've moved to a 4-digit number instead of a 3-digit number for the account numbers. And just because we have more accounts, and we may need to throw more in there and be able to have more room in between accounts to be able to do that. Some of the new accounts that we see under assets are merchandise inventory. So this is when we physically do a count of our inventory that we have, and we keep track of that. Allowance for uncollectibles. Now that we are selling merchandise to different people, they owe us money. Sometimes they're not going to pay us, and so we have to account for that. We'll come up to that a little bit later. Notes receivable, interest receivable. Again, people owe us money. More long-term than just an accounts receivable here. Looking at liabilities. You see a lot of the payables that we've had before. Now we do have sales tax payable now, right? Because that's something we have to collect when we sell our merchandise and send it to the state governments. These are all of our payroll accounts that we had, and you've seen those as well. What I want you to notice here is that we don't have accounts receivable and accounts payable to individual companies. We just have one overall controlling accounts receivable account and one overall controlling accounts payable account. And we'll talk about that in another couple of seconds. Then down here we have our stockholders' equity, which is basically like our owner's equity, right? Assets equals liability plus owner's equity. But because this is a corporation, we are dealing with stockholders' equity instead of owner's equity. Retained earnings is basically the same thing as capital. Okay, it's going to work and act just like capital. The capital is the owner's part of a sole proprietorship, and retained earnings is the owner's part of a corporation. Dividends is kind of like the drawing account. Dividends are what we pay our stockholders for just having stock because they are a stockholder. Just like if the owner withdrew money from a drawing account. Okay. Then we have our income statement accounts. Again, sales. We've had sales before. We are adding in some things like discounts and returns because sometimes we're going to give our customers a discount. Sometimes they're going to have to return merchandise, and we're going to have to give them credit for that. So those are some things that we're going to see in the next couple of chapters. And then we go to cost of goods sold. This is a cost, a group of cost accounts. They are labeled in the 5,000s. That used to be our expenses. The 500s were our expenses, but now we've got, again, adding some accounts in for merchandise. And So we've got these cost accounts. And this is when we're purchasing merchandise that we want to be able to turn around and sell. And so we're going to keep track of this, how much we purchase in these accounts here. And again, when we purchase something, we might get a discount. We might make a return because something was broken or not like what we ordered. And so those extra accounts are there as well. And these reduce our capital, and so these have a debit balance, and we'll look at that in some notes coming up. Okay, expenses. Again, anything that's an expense is pretty much here. Some of them we've seen: advertising, cash turnover, insurance, miscellaneous. There's our payroll tax, salary expense, things that we used in payroll. Okay, utilities expense. Now we are going to look at income tax, not federal employee income tax, but income tax payable on our profits as a company as well. So that's something that's going to be in there. Okay, and then another group of revenue, which isn't going to be sales, which is interest income, because if we have some customers that are paying us more long term and we're charging them interest, then that's a revenue to us. Okay. Now, this other little section down here, see it says subsidiary ledgers, and there's accounts receivable and there's accounts payable. So I pointed out over here that we've got a general controlling accounts payable account, but we don't have the hyphen, XYZ store or ABC company. Okay, we're not going to list each individual company in our normal chart of accounts anymore. What we're going to do is we're going to keep track of it in a sub-ledger or a subsidiary ledger. Okay, and so the balance of all of these added together is what you'll see over here, or actually accounts payable. All of these added together will be the amount that we see in this account. All of these added together are what we would see in this accounts receivable account up here. So now we're kind of keeping track of it in two ways, but it's a little bit cleaner this way so that we don't have a huge amount of accounts added because of the individual companies that we do business with. Okay? All right. I think what I want to do next is go ahead and do a page of T's. Okay? So you'll just need to get out a white sheet of paper. And this will just kind of be a notes page for you to help you refer back to if you need. All right. Some of these you should know by heart. Some of these are going to be new and relating to each other. So, of course, the ones that we should know, like the back of our hand: cash, normal balance of a debit. Okay, so there's our plus and our minus for cash. Supplies. Again, that's an asset. So a normal balance of a debit. Any accounts receivable. Okay, again, accounts receivable is an asset. And we'll have a normal balance of a debit. Okay. Then any expense. Again, utilities expense, advertising expense, rent expense, doesn't matter. Any kind of expense has a normal balance of a debit. Okay. And any accounts payable Any payables is a normal balance of a credit. Okay? Now, a new account is purchases. And again, purchases is only for purchasing merchandise that we're going to turn around and sell. So if we are selling widgets, we're going to buy widgets, we're going to do something with them, we're going to put them on our shelves, and we're going to mark the price up, and we're going to sell the widgets. Okay? So when we buy the widgets, we're going to keep track of it in the purchases account. Okay? If we're going to buy printer toner, it's a purchase, but it's a purchase of supplies. Okay? So just remember that this is only the purchase of merchandise. If you want to put a little note out there, just to remind yourself. Okay? Now, there are some accounts that go along with that, and I kind of pointed them out in the chart of accounts, which is a purchase discount. Oh, sorry. Okay, so this is a normal balance of a debit. Just like an expense, it's a cost account. It decreases capital. And so just like expenses decrease capital, it's a debit balance. Okay. Then we're going to have purchase discount. And this, again, would be where we make a purchase. Maybe we work a deal, we get a little discount, we're going to pay early, we get a little discount. And so we need to keep track of the discounts separately. And we'll do it with this account. And it'll be opposite. It's called a contra account. It's going to be opposite of what the normal balance is here. Okay? Because this is actually going to decrease this. So if this is going to decrease purchases, we've got to have the opposite normal balance. Okay? And then the other one that goes along with that is purchase, return, and allowance. And so this account helps us to handle anything that we return. So if we purchase something, we get it, it's the wrong color, it's broken, whatever the case may be, and we're going to return it to the person we bought it from, we're going to keep track of that here. Okay? Maybe it's broken and we're not even going to send it back. It's not really a return, but the company's going to give us an allowance for that because it's not worth sending back. So that's kind of what that account is used for. And it's also going to be the opposite of purchases. And again, these right here are called contra accounts, because contra is going to be the opposite or the reverse of our original account. Okay? So then we purchase our merchandise, and then of course we're going to mark up the price and we're going to sell it. And that'll be the sales account being used. Okay? Sales account, as we know, should know by heart, that our sales account has a normal balance of a credit. Okay? And then again, we're going to have sales discount, okay, which will be, again, a contra account, so it'll be opposite of our normal account. And we'll have a sales return and allowance account. And again, using these accounts, we make a sale, they're going to pay us really quickly, we're going to give them a discount for that, and we're going to keep track of it in a separate account. Okay? And so it'll actually reduce the amount of sales that we had. Also, sales return and allowances. We sold something, it was the wrong color, it was broken, whatever the case may be, they're returning it to us. We're going to give them the credit for it, and we're not going to decrease sales. We're going to increase our returns and allowances, and because it's a contra account, it's decreasing sales. Okay? And again, these are what we call contra accounts. Okay? All right, so then another one that actually goes along with sales that we're going to have to include now is sales tax payable. And just like Social Security, Medicare, we collect it and then we got to turn around and send it back out to somebody that we owe that to. So we make a sale, our state, our city sets some sales tax percentages. We have to calculate what that is. We have to add that on to the dollar amount that we charge our customers, and then we hold on to that, and then we turn around at a certain time and pay that to the state or the city. Okay, and again, just being a payable, it's going to be a normal balance of a credit. Okay, and then we're also going to look at the dividends. Okay, again, dividends is similar to drawing. Okay, so drawing has a normal balance of a debit. Dividends is going to have a normal balance of a debit. And then when we decide that we're going to pay our stockholders, then we're going to move it over from dividends to dividends payable, which again is kind of a contra to that. And so, and it's a payable, so you can see that we've got a credit balance there. Okay, so these are some T accounts that are going to help you through this chapter and some of the future chapters as well. So hold on to this. Use that as you need to. Add to it as you need to. Okay. All right, and then we're going to go ahead and look at working together 9-1. And this is pretty basic. I think I've talked about, I know what I want to talk about before we move on to that, are these sub-ledgers a little bit more. Because actually that's what we're creating here. So here's just a good graphic in your book, okay, that these are all of those sub-ledger accounts for all of those different companies. So here we have Wine Lightning, S&R Imports, right? These are accounts payables for each of those individual companies. And we take all of those balances, we add them up, and that's the number that's actually going to go into our accounts payable. So now with our normal accounts payable account, we're really just working with totals. Okay? We're not going to individually track here the individual purchases or sales to these companies, okay, on account. Again, this is called the controlling account. These are called the subsidiary ledgers or the subsidiary accounts. And so we're actually going to have another set of ledgers, okay, specifically for those businesses. Okay, so we're going to have the general ledgers, and then we're going to have subsidiary ledgers. And so we'll keep track of the individual companies in one ledger, and then again in this accounts payable ledger we're only going to keep track of totals. Okay, so for our working together, all they really want us to do are set up a couple of accounts. And we'll actually do another notes page as we go through this. It just tells us that we want to start a new page for an accounts payable ledger for Warren River Supply. It gives us the account number. Notice this is a 3-digit account number. It's not falling into our big chart of accounts with a 4-digit number. It's got its own numbering system. And then it tells us what the balance is. So we'll put that in there. Okay? All right. So, this is an accounts payable ledger form, and please note that it's a subsidiary ledger. Okay. And again, it gives us the company name as Warren River Supply. Okay, and notice it says vendor. A vendor is somebody that we buy from. Okay, when we get to an accounts receivable ledger, this will say customer because those are the people we sell to. Those are our customers. But when we're a customer of somebody else, that company is our vendor. Okay? And the vendor number, they tell us is 240. Okay, and then it says on October 1st, so give us the year, October 1. We're not going to write much in this item column. We are going to tell it that it's a balance. It's brought forward from a previous amount. And so this is all we're going to do here. Okay, and this is just setting it up. Eventually we'll come in and we'll put, the individual amounts here as we go back and we buy things from Warren River Supply. Okay, so Zodiac Industry is our other vendor. And they are vendor number 250. And this one's also on October 1st. And this is just the balance. So we're setting this up. We will post these into their own ledgers. Excuse me. This is where we are going to post. Sorry, misspoke there.